Warm welcome to the Mutual Fund Show. My name is Nimesh, and as this become a tradition for us, I think this is the second or the third year on the trot that we are doing either a Diwali special or a year-ender special with Nimesh of ICICI Pro AMC, and he joins us today as we wind up, or as we look to wind up, a really dramatic year 2020. Mr. Shah, good having you. Thanks so much for joining in. Hope all is safe.
Very good. We have learned the new way of working, and it's working very well.
But okay. Yeah, it is for a lot of people. And I think you are doing some pretty interesting things as well, in which you're launching, I think, a fund offering as well at the fag end of the year. So we'll talk about all of that. But like we do every year, we kind of want to start off, or at least I want to start this off with from a mutual fund investor's perspective or a mutual fund manager's perspective. What are those one or two key things that stood out for you in terms of learning for year 2020? I know there will be a bunch of things, but if I were to request you to narrow it to one or two.
I will narrow it to only one, not even two. It's macro, macro, macro. Right? 2020, like 2008, we have been seeing it since a long time. But 2020 has made it very clear that ultimately you might, while micro bottom up is very important, but you cannot lose sight of macro. Right? You cannot lose sight of macro, and macro investing is extremely important, because the government or the world decides the policies. What has happened in 2020, you could not have made your calls right. You could not have done anything right if you had not had the eye on the macro, right? The kind of money that has come in, the kind of money that is printed in. If you didn't have an eye on that, the central bank balance sheets around the world have moved from 20 trillion to 26 trillion, you could have in no way anticipated that this kinds of inflows can come into the market, which can cause this kind of rally. Because the situation at the ground level looks so weak. Say, let's go back to March. If we see 2020, March, the way market had discounted, right? There was nothing wrong in that. All our industries were struggling. The factories were closed, right? So what the market reacted was a perfect logical thing to do. That bottom up, every EPS during the year has been affected. And if EPS has been affected, then market should go down. And that's what happened in March. It would have been very difficult to take a call at that point of time. In the next 6 months, in the next 3 months, by June, we were, as the market reached 30 at 26,000, we came on your channel also and give a big buy call, right? That's what we had done at 26, 27. But at 35,000, we started reassessing ourselves, right? That whatever the market had reacted, the markets had gone down from 40,000 all the way down to 26,000. And again, the markets have come back to 35, 36,000. What do we do with our buy call? But we did not want to give a hold call or a sell call at 35,000 again, because we could see a macro trend coming up that central banks are expanding their balance sheet. People are printing money left, right, and center. And you cannot fight a central bank, though the fundamentals were not in place in India. In June, July, the fundamentals were not in place, but we did not have the guts to fight the central banks of the world, right? Today, markets are being run by the central banks of the world, and one should not take a position against the central banks of the world, whatever micro might tell you, right? That's what the reality is, that micro can tell you a different story, but you cannot ignore the macro. So 2020 has been a great learning. We were at ICICI Prudential, we have always been talking about, when I always come to your channel, I always talked about balance advantage fund, etc. Right? But that balance advantage fund is also to extent taking allocation on equity and debt based on macro fundamentals. So this, I think, 2020 should be remembered as a year where macro investing in India has come into play.
So how does that set us up for 2021? In that world over, we don't seem to be out of the crisis, but we are on the throes of the vaccine, or in fact, it is being administered as we speak. And in India, even if we might be a bit far away from the vaccine front, on the COVID-19 infections front, I think we are doing remarkably well compared to the rest of the world, especially the Western countries. So how does the macro therefore set us up for the early part of 2021?
That is a very interesting one, because right now we are at an all-time high market. But let's analyze where our market is today and then talk about the next year. Right now, is it an expensive market? Yes, it is an expensive market, right? Historically, we are at a 36 P, if you see historical P, And if you look at forward PE also, we are at 24, while our history is that the forward PE is around 17, 18, right? And we are at a forward PE of 24. The market is not cheap, right? That is very clear. But when we analyze this market, there are 50 stocks in Nifty. And when we analyze it further, I will say that the top 10 stocks since January 2018 market was high. And let us see that time from 18, 19, 20, 3 years we have got. In 3 years, the market looks good, right? Market has given a good return. The market has given a Nifty return is about around 31%. But when you go into the details of it, the top 10 stocks have given a 70% return. The next 40 stocks have given actually minus 10% return. That's the, so I am saying last 3 years, we have seen a very, very narrow rally. And last 3 months, that nature of the rally is changing, right? What has happened in the last 3 years, that expensive stocks have become more expensive. The top 10 stocks, which all of us know, have just gone out of the valuations are just out of the roof for the top 10 stocks. The remaining market, so overall, when I said the market looks at an all-time high, the 24 PE of, it looks high, the forward PE of 24 looks high. But when you analyze that, it is only in the top 10 stocks. The remaining 40 stocks, even of Nifty, do not look as high as they looked earlier. In fact, the small cap is down 24% from January 2018. So when last 3 months have shown that the market is getting broader and broader. The rally is getting, it's not restricted to the top 10 stocks. If you see last 3 months, metals has come back, right? So a lot of sectors are coming back. Pharma, during the year, we have seen pharma coming back. So sector by sectors are coming back and we are quite well positioned. So, and I think we are positioned for I'll give another macro call that we may be positioned with what is happening in the metals in the world. We are positioned now for an inflation coming back into the, and what we have been seeing, in addition to food inflation, we believe the next year or two, we'll see inflation coming back, right? And inflation coming back is very good for the corporate side, right? For the corporate EPS, it's a good sign that is happening. So we have seen a market of last 5 years where we have seen a CAGR of 11% in the market, but we have not seen any earning per share CAGR, right? So earning per CAGR has got to do a huge catch up. So I feel beyond the top 10 stocks, the market does not look that expensive and there are opportunities, all that. So a macro call on the flows, that why the flows have been coming into the country, and with the central bank led rally where flows are expected to come in, we expect dollar to weak, we expect that inflation will be back, and we expect that the recovery cycle is on in the country and it is doing well. So we will have to, what has not done well in the last 5 years can do well in the next 3 to 5 years. That's what our policy.
So therefore, you would believe that the investor of the last 3 years, who may or may not have seen terrific returns in his mutual fund portfolios, and I'm not talking about the blue chip or select portfolios which have done well, but largely some of the others which may not have done well, you will see the return to performance from a lot of those portfolios, which might have mid-cap stocks, which might have commodity or economy-linked stocks, etc. All of those could actually do well going ahead in 2021-22.
See, in a narrow rally, a mutual fund is supposed to not perform because mutual fund is diversified. A typical mutual fund will have 40 stocks. So when the market is narrow, suppose one particular stock in the index will be 14%. Will I go and put the investors' money 14% in one particular stock? I will not do that. I'll be diversified. I'll have 2 or 3% in that particular stock. But that stock goes up 100%. Then mutual funds are designed to underperform in this kind of market. I would be more worried if mutual fund outperforms in this market. That means it is running a very concentrated. Only a focused rally, which has matched with the top 10 stocks, which believes in taking expensive stock, can only do well in this kind of a rally. So last 3 months has been, if you see what has happened in the last 3 months, value is back. Cyclicals are back. And that I expect that trend to continue. If you see a sector like power, if you see a sector like telecom, let's look at a sector like telecom. All of us, our day, we are talking to you based on our telecom network, right, in the country, that I have got a good Wi-Fi in the house and I have been able to and run entire ICICI Prudential has run from their houses, right, in the last 9 months. So if that is possible, where I had to bring out daily NAVs every day, and daily NAVs, so telecom has its importance in our life. right? It is next to roti, kapda, makan. Wi-Fi is also a part of that. Despite that, and there are only 3 companies in telecom in the country, 3 or 2.5 or whatever you may consider, right? So, is there space of some of the companies? Do we see that in the next 2-3 years there will be a growth in the amount that we pay for telecom? Nowhere in the world is telecom as cheap as it is in India, right? Any country in the world, no country in the world can be as cheap as we are in India. Will we increase by somewhat the revenue charges from India? Yes, we will increase. And when this increases, it will show in the telecom revenues and telecom EPS. Another sector, power, right? The power has been quite, if you see some of the prominent companies in power in the country, they're available at a single-digit PE because maybe they are owned by the government and the people are not confident. But power, I can clearly see some of the companies, their ROC is decided in advance, right? They know what is the as the facility comes into play, there is a fixed return that the government gives them. So it's a very good industry to be in, where it is in single-digit P. It is giving a dividend rate which is much higher than the interest rates in the country. So I think there are a lot of value spaces available in the markets today.
So how does the average mutual fund investor take advantage of this? You you have the intelligence, the army to be able to tell you all of these things. What does an average mutual fund investor do in such a scenario? Assuming that he believes in the theory that you're giving right now.
I will again replay the tape that I have been playing since last 5 years on your channel, which has worked also. I have been saying that it has to be we believe when it is a flow-based market, what we have discussed till now, that it is a flow-based market, that flows are coming in, that's why the markets are. So the flows can be volatile. And with that volatile, if you have seen what has happened in 2010, what has happened in 2011, 2010, the markets went up, 2011 markets corrected, 2012 markets went up, 2013 markets corrected, because the flows were happening that way, right? So in a flow-based market, volatility, a flow-based market, which is very highly valued, volatility is given. Right, so retail investors will not be able to withstand that kind of volatility. A strong message from ICICI Prudential that you have to be in balance advantage fund categories. We have got a fund called asset allocation fund, which decides what assets to put in which one. Right, so it is an asset allocation fund. It is balance advantage fund, and we have come with a very interesting concept of business cycle fund. Right, so those are the 3 bands. I would talk about that as we go ahead. But understanding these are the 3 funds that we recommend. Earlier, I used to very confidently come on your channel. Last year, when I came this time, I had recommended debt. It has played out beautifully. But in a scenario when I recommend debt investing only for 3 years, and in a scenario like today, that in the next 3 years, I expect interest rates to go up, you will not make money out of the wallet of interest rates going up. Right, so that is why I'm saying that either it is asset allocation fund, either it is balance advantage fund, or the third option is the business cycle fund that we are coming up with. These are the 3 things that I see retail investors investing in now.
Okay, just before I come to that, because I would want to know a bit about your business cycle fund, of course. 2020 is also seen this very peculiar characteristic wherein presumably the average retail investor who was parked in mutual funds for the last 2-3 years, maybe suddenly looking to the west or just taking advantage of the bottoms, etc., probably shifted some of that portfolio into direct investing as well. Do you reckon that mutual funds over the course of the next 2-3 years, as the cycles move the way you expect them to, would be able to show out performance at large? I mean, frankly, except for a few schemes, maybe because of the very nature of the product, mutual funds over the last 2-3 years haven't quite given the returns that people would have anticipated them when they put the money. Do you think the next 2-3 years can be different?
So it's very good that a lot of people are getting into direct equity. Right, I am not sad about that, because a lot of digital channels are getting people into in. But this has happened earlier. We have seen in 92, right? All of us have now spent 30 years in the market, and we have seen what happened in 92. We have seen what happened in 2000. We have seen what happened in 2008. So it's whenever there is a rally, a lot of people believe that they are smart investors, and they do come in, and it is healthy that they come into the markets. Over a period of time, they'll realize that they make money in 2 or 3 stocks, and 5 stocks they might lose money. Because let's see a complete cycle, right? We have seen only 6 months of the cycle where people have found, because people started coming into the market, say in the February, March, and they have made a lot of money. So a lot more money is coming into direct equity. So good for them that they have made money. We will remain diversified, because risk management for us is very important, right? The mutual funds will be diversified vehicles. In narrow rallies, we are okay that some of the mutual funds would not have performed to the extent that markets have performed. Last 3 months is already changing. So we are a 3-year, 5-year players. So you should come into mutual funds only if you are 3 and 5-year players. Otherwise, you should not be in mutual funds. So all those people who are getting into direct equities, if they have the knowledge and they can, over a sustained time, they can manage performance, it's good. But if they cannot do that, over a period of time, they all will become mutual fund investors. That's what my view is. So that I am not hassled at all of what has happened in the last 3 years. In fact, it's a very healthy sign. That's what I'll put it.
Okay, so let's wait for the outperformance. Just one more question. The last 2-3 years have also been, I wouldn't say tumultuous, but in a way, very high front and center event specific from a debt fund perspective as well. And it's kind of culminating with the Franklin Templeton e-voting process as well. And that was kind of the poster boy of 2020 when it comes to debt news. So what do you reckon a debt mutual fund investor has in store? Because I also asked this to you because you made this very interesting comment that you believe that in the next 2-3 years, we might see the return of interest rates moving up, and therefore debt investing would be different than what it has been in the preceding 5.
So what I say will gel or not gel with your retail investors, I'm not sure. But I have always been saying that in debt, we can invest in a fund like ICICI Prudential Credit Risk Fund or ICICI Prudential Medium Term Plan. I'll put it why I'm saying that. Right? There are times when you invest in accrual. There are times when you invest in duration. Duration is when you expect interest rates to go down, you invest in duration, because when interest rates go down, you make money out of it. That time is over. Right? That time you cannot be investing in duration now. Right? We don't expect interest rates, whatever is happening in the country, the macro features of the country, we do not expect that in the next 3 years. And when I say debt investment, I'm not talking about opportunistic people who put in today and get out in 7 days. I'm not talking about that. I'm talking that 3 years, it takes 3 years to get tax advantage. So if somebody comes in, I always say that he will be staying for 3 years. So if you're staying for 3 years, there's no point in investing in duration funds of ours, right? You should invest in accrual funds of ours. While I understand that there has been an incident in one of the mutual funds in the country, and there were some other credit events also in the country, and some of the mutual funds that got affected. But from ICICI Prudential Mutual Fund side, there has not been a single person with whom we have invested debt, and he has even delayed by a single day till date. We have been in this business for more than 20 years, and not a single day's delay we have had in any of our instruments. So there has been not a single event from. So that is, in fact, this particular 3 years have showed with mutual funds which you should be investing in on the debt side, right? Because ultimately you need to have those kind of processes and credit side that will make you decide where you will invest on credit and where you will not invest on credit, right? So credit, AA, investing in AA rated companies, investing in A+ rated companies is the only way you can make some money out of debt. By investing money in AAA companies, today AAA companies are borrowing at 3.5% and 4% for 3 months. How will you will not make any kind of alpha if you keep on investing with AAA companies, because the spreads have just gone for a toss. So AA companies of India are good. They are good investment options. We have always been investing, and we will continue investing in good AA rated corporates of India. And we have not had a single negative experience till date. I'm not saying that in future also we can't have. But if there is an incident, we will be, first thing, I have got a risk management practice in place whereby we are able to decide where to invest and where not to invest on the debt side. We have got an integrated team. See, my CIO equity is also the CIO for debt. He's a common CIO. So I believe that equity guys can look forward, while debt guys can analyze the past well. So mine is an integrated team where the debt analyzes things quite well, and equity is able to take a call that ultimately all of us sign off when we invest in debt. Anything less than AA, if anything has to be signed off, all of us get into signing off. And there are 6 people who are using their mind and signing off on this one. So that has also helped us.
No, but
so approval funds, I don't think, completing your question, coming directly, I think ICICI Prudential Credit Risk Fund or ICICI Prudential Medium Term Plan would be a good investment for with a 3-year paradigm. But please realize that FD rates in the country have go down. So what has happened? If you see, don't look at my last 1-year return. Say a medium term plan would have given 14% return. I myself have invested and I had got 13-14% return in the medium term plan. That is not possible. That is possible because from March to now, interest rates have just gone down, right? So, but that is not going to happen. You are not going to get those fancy returns. Look at the fixed deposit rate of the banks, and we will try to get something more than that. That is what our endeavor would be.
So, but somebody who's invested, say at the start of the year in the plan that you mentioned right now, wherein the 13-14% returns came in, while you expect interest rates to move up, you also mentioned that investments in debt funds, ideally because of the tax advantage, should be for 3 years. Is it advisable to go with the belief that rates are going to move up and get out of those funds? Or would you stay put because it's better to get the tax advantage at the end of 3 years?
I was a big investor. You are asking what will I do, right? I have invested post Templeton. I'll give that answer because that what am I doing with my money is the best thing to answer. Now, I had post Templeton, interest rates had just spiked up like crazy. On a double rated corporate, you are getting 10 and 11% in India. So I had gone full time and I had invested in March, April, May, June when the Templeton crisis was at the peak. We had gone and invested. I had gone and put my personal money into debt funds, right? In my credit risk fund or in my medium term plan. And it has given very good returns. I'm not taking them out now because if I take them out now, I've done the calculation that if I take them out now, I will have to pay tax on that rather than I invest it, I keep investing and complete my 3 years. And then if I take out, it is much more beneficial for if my reinvestment, I would take it out and put it again. If my reinvestment rate is more than 7 to 8%, if I can reinvest that safe money, I'm talking about my safe capital, which I want accrual on that. If that safe capital, I can go again and invest in a AA rated company at 8% plus or 7.5% plus, then I should remove the money, right? That has been my way of looking at life, that if my reinvestment rate in debt is good today, then I should remove. Otherwise, I should not remove because I'll unnecessarily pay tax on the earlier one. But everybody should look at his tax workings and then decide.
Well, thanks for that candor because it really helps people. So thank you for that. Can you talk a bit about this business cycle fund as well? Because I think it brings out the thesis that you as a house have on equities at large over the course of the next 2-3 years. What kind of investor should look at this fund, and what's the basis of the success that you believe such a fund offering can have?
See, if you see equity investment right from 1990s till date, see 1992 to 2007, it has always been a very micro investing. I started my career in 92, 93. It has always been stock picking, individual stocks you have picked up. Somewhere in 2008, we realized you can do whatever you want to do, but at the end of the day, if you don't understand macro well and you do not align your portfolios with whatever is happening in the macro, because central banks started supporting markets since 2008. It is not a new phenomenon. Central bank balance sheets in 2008 were $5 trillion across the world. The developed market central bank, the total balance sheet size of central banks in the world was $5 trillion. That $5 trillion in 2008 has become, on March 2020, has become $20 trillion. So central banks were expanding their balance sheet, in turn were supporting the markets all the time. From March 2020 to November 2020, already that $20 trillion has become $26 trillion. So it's all macro investing where there is policy interventions happening because of which the markets are at a certain level. They are creating what do I say? They are creating a positive sentiment across all markets, whether it is debt, whether it is equity, whether it is gold, whether it is metals. So every market in the world is up, right? Because of it is central bank. So there is a macro trend that one has to recognize. What has happened in India is also a macro trend. So we have to recognize that macro investing is in place. Some sectors will do well, some sectors will not do well. And you will have to take that call, which sectors will do well and which sectors will not do well. It is completely against what we launched in 2008. In 2008, we launched a product which is the biggest fund in the country, ICICI Prudential BLUECHIP Fund, right? I'll just explain what is ICICI Prudential BLUECHIP Fund, because this particular fund is everything what ICICI BLUECHIP Fund is not there. ICICI BLUECHIP Fund is a very, very disciplined fund which will only invest in there won't be major sector deviation in ICICI Prudential BLUECHIP Fund. So retail investor wants to come into equity market, we blindly tell him that you go and put money. If you want to invest your equity allocation, you always start with BLUECHIP Fund, because it will not take sector deviation, right? And if your idea is that you have to beat Nifty, then it is an ideal fund to invest in, because you will not take sector deviation. It will do stock picking within the sector. That's all it will do. But if financial services in the country has got 35% weightage, ICICI Prudential BLUECHIP will have 5% here or there. But it will always be invested in that sector to the extent that Nifty is invested in that sector. So it does only stock picking within the sector. But this particular fund is very different. It is taking a macro trend that these sectors will do well. And based on that, our understanding, instead of taking bottom-up stock picking and then deciding that these are the 40 stocks I'll have in the market, the way BLUECHIP will decide, we don't do that. Here we'll say that these are the 4 sectors that we believe will do well, that in the current circumstances, power will do well, telecom will do well, capital goods can do well, because it has not done well all this past. India is recovering. So policy initiatives have taken in place that capital goods can do well now. Well, so we will take those calls. We believe that real estate will do well. Because of real estate doing well, construction will do well. So we will take those macro calls, and we believe metals will continue doing well, mining will do well. So we'll take that call and we'll go ahead and invest in those sectors, right? And one of the risks in that particular way of investing is that suppose our macro call goes wrong, right? It is very much possible that it is not this one that we bet on a sector and that sector does not do well. So first of all, we'll have 4 or 5 sectors that we bet on. And then the second element is that we have done there are 3 fund managers in this fund. It is not a single fund manager, right? Anish Tawakle, who is a good macro thinker, my CIO is also a macro thinker. Naren is a macro thinker, and he is also there. Anish is there. Anish is also a good macro thinker. And we have got one of our debt fund managers as a fund manager in this equity fund. This is the first time that has happened, that one of our debt fund managers is into it, because this is macro thinking. So 3-4 of them together are going to sit across the table and decide which sectors to put in. So we can go wrong on sectors, but maybe 3 people coming together and discussing, the probability of going wrong would be that much lesser, right? So it is a macro. So that's how we will go about it. And 2008 onwards, we are clear that that's how we are going to manage this one.
So it's a bit of a turnaround sectors kind of a fund. Funds where there is value, you would look to invest in those and hope that over 2-3 years, they will significantly outperform the benchmark CAGR or XIR.
It need not be value at all. We are very clear from the fund manager that we have put up in this particular thing, Iyab and Anish. Anish is running a BLUECHIP fund. BLUECHIP fund is not value, right? So we are very clear that it need not be a value. It can be something that we expect to do well in 2021 itself.
Okay, sure.
We have got a fund of funds called Thematic Advantage Fund. Again, macro. Earlier, we didn't have this business cycle fund. So last 1 year, if you see, we have got a fund called Fund of Funds, which is called Thematic Advantage Fund, which decide which themes will do well in 2021, and according to that, it will invest in those themes. So it's something very similar to that kind of thinking of what will do well in 2021. In 2021 end, when I meet you again, the sectors that it would be invested in would be very different.
Sure, they could be.
It depends on our cost. So it need not be value. In fact, it won't be value. That's what our sense is.
Okay. One final question, Mr. Shah, and that is on a phenomenon that really snowballed or became very, very large in 2020, which is Indian retail investor investing not just in India, but beyond the Indian shores. Direct equity investing, mutual fund investing, both. What do you think is in store for Indian mutual fund investors who want to invest abroad? How do you look at 2020 from that lens? And how do you think the next couple of years are in store, particularly 2020?
It requires a lot of expertise to do that, right? We have to first Indian investors to develop expertise of investing in India. And then he should also, it's a very good thing to do, because there are a lot of sectors which are not present in India at all. So I think it's very healthy, this trend, if it picks up. And I think it will pick up in people who are already invested in equity. So I don't see the Indian retail per se investing so much into it, but the Indian HNIs will invest in this particular space. That's what. You are already invested in India. Now you want further diversification. If you invest in India, you don't get defense. You don't get the innovation that you get in US markets, right? So we had launched a fund called ICICI Fund of Funds, again, like Thematic Advantage Fund, which was a fund of funds which invest in funds which are in that particular themes. There is a global advantage fund of funds that we have got. What does it do? It goes and invests in my competition products also. It need not invest in ICICI Prudential mutual funds. It's a fund of funds which invest in mutual funds which invest globally, right? So it's a very good thing to do. And so ICICI Prudential Global Advantage Fund is a very good option that I believe that if this particular sector does well, I will go ahead and invest on that. So if you have got your own expertise to understand that Russia will do well, then go ahead and invest in a Russia ETF. But for that, you need to have that much knowledge about the Russian markets. Or you go ahead and invest in a global, or if you believe that oil will do well, energy will do well, which is our call also. So this particular fund of ours can invest internationally also. A business cycle fund. If we believe that oil will do well and there are not sufficiently good companies which can get upset because of oil in India, then I may go ahead and invest abroad also, internationally also in oil companies. So I think it's a very good trend to pick up that we should not look only at India, because macro investing requires international investing also.
Well, so viewers, if you can do it yourself, great. But otherwise, there are a bunch of mutual fund options available as well. Mr. Shah spoke about the one at ICICI. Maybe consult your advisor if you believe in him or her for options across, but just choose wisely and don't go out and invest directly if you don't have the expertise and the time to monitor that. But Mr. Shah,
if I intervene just now, in 2012, we started a fund called as US BLUECHIP fund. Right? It was perfect timing. 2012, we invested in it, and it has done very well for the investor. Right? He has got a very good double-digit return out of it since 2012. But today, instead of investing only in US, which is at an all-time high, maybe one goes ahead and does a global advantage fund investing. That's what. So that he gets various different markets.
So viewers, this is the thing. I mean, go out and maybe invest directly if you believe you have the expertise and the time to do that. But if you don't, then please consult somebody to try and figure out which are the options available. Mr. Shah just spoke about one of the options that they have as well within their portfolio, which allows you to invest in global funds. Mr. Shah, one final piece of learning, something that stood out. I know you mentioned from an investing side, macro remains the top draw, but anything else that you want to leave us with?
No, I keep on saying the same things again and again because I don't want to confuse investors with too many things. So either it is balance advantage fund or asset allocator fund, or it is business cycle fund. That's the way you invest in 2021.
Okay. Well, we'll leave it at that. Thank you so much for taking the time out, and wish you and yours and everybody in the ICICI family a very happy 2021.
Wish you the same and wish your viewers the same. Thank you.
Thank you so much, Mr. Shah. And viewers, thanks for tuning in to this leg of the Mutual Fund Show. Have a fabulous 2021.